Anyways, I guess we can start. We'll just keep it super casual, right? Considering everyone else is keeping it super duper casual. Uh, but yeah, I mean, so this is the real world asset derivatives panel, and I think we can start off with just some introductions, considering what's going on. But yeah, keep it casual, just a conversation. Let's just start from the left. Go ahead, bro.
Cool. Hello. Hi. My name is Jesse. I work at zkSync, focused on a lot of the real-world asset stuff there. And in another life, I worked on TradFi infrastructure. At zkSync, I work on payments, consumer, and commerce sort of applications. Maybe we could wait for the room to quiet. Yeah. How on time are we? We're good. Okay. Yeah, but at zkSync, we work with a lot of, interface with a lot of TradFi institutions, but there's also a bunch of long-tail markets that are really interesting that we can talk more about today. But yeah, great to be here, and thanks for having us.
Thank you. Please.
Yeah, it's good to be here today. My name is Matt Schmenk. I've been at Avalabs for 2 years now, primarily focused on DeFi and institutional and capital markets. Before joining Avalabs, I worked in traditional finance for couple years directly out of undergrad, and I'm on level 3 of the CFA and have some programming experience as well, but very happy to be here today and looking forward to speaking more.
Hello, I'm Pranav. I'm a solutions architect at The Graph. Before that, I used to be at Polygon, and in my previous life, I was an engineer. I'm still an engineer, but yeah, in crypto, the line is very fine. Happy to be here talking about RWAs, something really interesting and impactful in the scheme of world.
Yeah, hey everybody, Jim Hiltner. I'm one of the founders of Superstate. Before Superstate, I worked at Compound. I was leading the go-to-market for the institutional business inside of the protocol. And before that, I was in TradFi. Clearly, I'm the guy up here with a blazer on. So really great to be up here with you guys.
Yeah, hi, my name is Ian McAfee. I'm the co-founder, CEO of Shift Markets. We started in 2009 doing FX. So we built out marketplaces in the FX world. Started to do that in crypto in 2017. And now we're trying to move FX on chain. So we're going to talk about that today. A project called Cables Finance. Yeah, excited to be here. Thanks for having us.
Thanks, guys. And I'm probably the most based and hungover individual on this panel, truth be told. I'm employee 0 at a DeFi AMM DEX on Doge, so we'll hold all the laughter and the crazy shit for later. But yeah, let's just get right into it. My first question is, we know there's like a lot of assets that's going to get ported over, right? There's like money markets of US T-bills, bonds. Franklin Templeton's on here. Polygon, ETH, Ondo has US short-term T-bills. Like, what's the next thing that you think is coming on there? We can start with most based to most suited.
The next phase beyond USTs and basically streaming, I think there's a level of like the fundamental requirements to get real-world assets on chain is something where you have to go through this KYC process and you have to have someone managing this level of the process, and Ondo has a really good flow for this. I think stuff like Goldfinch is quite interesting, where you can target consumer lending in emerging markets, where there's, in emerging markets there's no credit standard like we have in the U.S., where we have S&P or these sort of things. So there's a lot more of opportunities in terms of extending credit and expanding, how you underwrite individual risks. And Goldfinch kind of obfuscates this away and allows people to access these sort of longer tail markets for extending credit. I think that's quite interesting.
Yeah, it's kind of interesting because I think the second order effect of bringing tokenized treasuries on chain is yield-bearing stablecoins. And generally that's done via like color marking. And so because those are kind of classified as securities, teams have to KYB or KYC if you're a retail user with the underlying stablecoin protocol, but then you get the yield of the collateral of that stablecoin. And so I think bringing up the risk-free rate in terms of using real-world assets as collateral, money markets, short-duration treasuries, et cetera, makes a ton of sense. I mean, it's kind of a no-brainer when you look at how much money something like Tether is making in revenue from the collateral backing their stablecoins. And so I think we're seeing more and more kind of yield-bearing stablecoins, whether it's USDV from Matrixport, USDL, et cetera. And the protocols supporting those assets can generally receive the revenue from the collateral, and the team that essentially launched that stablecoin just takes a flat like 20 bips fee or something like that. And I do think that'll continue to bring up the risk-free rate and be that, I don't know, new baseline level of yield within DeFi. And I mean, it's still semi-permissioned, meaning you have to KYC or KYB, but I think a good bit of retail users, if they have access to get an extra 4 to 5% on top of whatever they're doing in terms of DeFi with that stablecoin, just makes a ton of sense.
Yeah, in my opinion, there is a correct answer and an answer we want to hear. The answer we want to hear is basically we are going to go through mass adoption. The Denver is going to be tokenized. Real world assets like the buildings are going to be decentralized, or like what Larry Finn says, the whole of the stock market is going to be decentralized. But the real answer, in my opinion, is that basically we are an APY-loving industry, right? We only look, or what the shiny products are the products which have crazy APYs. So in my opinion, as of right now, humbly, I feel T-bills are the most shiny part of the industry. And when I was in Turkey during the Dev Connect, what I saw was people were straight away taking their salary and converting them to USDC. But now they find another avenue where they can also put some money and get the 5% yield on the USDC, and that's pretty much secure. So in my opinion, as of right now, that's going to sustain. And what I don't hope, but what I see is there are going to be protocols building on top of these yields to multiply the yields and multiply the yields and even more multiply the yields. That's the scary future, but a good, nicer future would be if these particular trending or emerging markets could have more stake in these MUSDs or yield-bearing stable coins, as we talked about, and basically stay away from inflation and can reach more of equalized pay gap issues.
Yeah, so I think you brought up a barbell distribution, which I'm seeing a lot of on chain, which is like you've got one end of the spectrum where stablecoins have clearly like just absolutely crushed it. I think they're at like 140 billion now. Like at the nadir, they were like 120 billion. Like very clear product market fit. Haven't really moved and done anything. Even though yields natively on chain, on like Compound, for example, went to like 2%. Like everybody still loved stablecoins for a whole host of reasons. Then you start like moving up the spectrum, and you got T-bills that are coming on chain. You've got products like everybody mentioned here. I'll plug Superstate's got a product in that space as well. But then there's all the other end of the spectrum. You all of a sudden jump over a bunch of credit and a bunch of duration, and you all of a sudden go to like, emerging markets, fintech originators that like may not have a track record, and there's a ton of adverse selection and that kind of stuff. And like the yield seems pretty interesting, but at the same time, like performance on those might not be all that sustainable. And so there's a lot of wood to chop in between the two of those. And I think what it really boils down to, in my opinion, is like, who cares? Like, and who wants this? Like, it's really easy now that the tech is there to like start to originate a bunch of stuff, like a building or a watch or like a Picasso painting. And like, that's cool, but like, who cares about it on the other side? So what I think, really this industry needs to like focus on is from the client perspective. Where is the demand? And like, you could go in the treasury space on like a lot of protocols are highly levered to their native token, right? And they got to run a business and pay developers and grants and have a sustainable long-term trajectory for the next cycle. So when you look at a typical corporate balance sheet, Coca-Cola is not investing in T-bills and fintech originators. Like Coca-Cola is investing in a basket of a ladder of multiple durations on treasuries. They're investing in investment grade, high yield debt, like a whole bunch of things that happen in between those two ends of the different spectrum. And I think that's kind of where folks are starting to wake up to understanding that those opportunities can come on chain, and that evolution needs to happen. Now, in addition to that, we're talking about yield, of course. But then the other thing is, crypto provides opportunities for people to get access to assets that they don't have, that they're prevented to from the like traditional financial ecosystem. And so if you think about opening up a brokerage account, if you're a crypto native hedge fund and you try to go to a bank or a broker and you're like, I want to buy some stock through you guys, or I want to open up an account, a lot of times it's really challenging to do so. So you can create real world asset exposure to things that like we probably all in this room have access to every day, but a lot of the demand side of our industry doesn't have access to. And I think that that's what we need to start to focus on.
It's really funny you say that, because that's something that we like to say at Ava Labs. You can really tokenize anything, but is there a demand for that tokenized assets? And that's, I think we've solved too much for the supply side of the tokenization equation and just not enough for the demand. And so I couldn't agree more.
Yeah, and sorry to steal your time, but I think there's, again, going back to the client side, right? And I think, there's been a lot of great efforts on the alternative space. And I think some of that has gone over your rails, right? Like where private equity funds or more alternative asset classes that traditionally like take a lot of work for an issuer to create. And so therefore the economics don't make sense for them to democratize that access to retail individuals, because just processing all these subscription docs and doing the KYC and all that from an issuer standpoint just like bleeds out all the economics. So they just go for like big $25 million minimum checks. Tokenization allows them to automate a lot of that processes and put it all on chain so that investors get the visibility into what they're investing in, and through smart contracts are able to move capital from intent to purchase. And it opens up an entirely new demand distribution channel for like the KKRs and the Hamilton Lanes and the Apollos of the world, which is amazing. But still, where is the demand, right? Like that kind of stuff is great to do, but like where are the retail individuals who are like, oh, I can put 25 grand into a 7-year lockup private equity vehicle. I'm not sure that that's the best thing for an individual's portfolio right now. Like it's cool to say you could do that, but let's make sure that there's actual like real product market fit first.
Yeah, just to take another take on it, I mean, I think there's people on chain looking for tokens of things, and that's a certain type of demand that we need to satisfy. There's also implementations where you don't need to expose the tokenization to the user to get the benefits of the tokenization, right? So you can give them the same look and feel of what they would have traded in the TradFi world, but do things on the back end that use the blockchain to make things vastly more efficient, right? So we're doing FX, right? So FX, largest market in the world by a lot, most liquid market in the world, but like if you're in an emerging market country and you want to trade with another emerging market country, you can't. You have to trade with the dollar, and you got to trade it with like one of 3 banks, and you get crushed on the price. And you have to do that again to get to the other currency. So there's a lot. The biggest banks control who gets credit, and they don't like the whole balance sheet risk in small currencies. So there could be a world where we can eliminate a lot of these middlemen, use the blockchain to make this process much more efficient, and start to make trading easier, right? Bring down costs, bring down middlemen, bring down credit costs, so you can make new markets. It's too hard, it's too much regulation, there's too much paperwork, there's too much legal and middlemen to create markets that are small. You need a big market to do anything real. And that applies even with small currencies of countries, right? So if we can do that and change that for currencies, we can do that for lots of other things too.
Dope. And you guys can feel free to jump in at any time, just chill. I have a question that's more of a smooth brain question. Okay. And I guess it's like also kind of a tinfoil hat question, to be honest. I used to be a suit too, and then I was like hoodie and flip flops.
I'm not a suit. Okay?
No. I mean, okay. But like
I've
my
got
question,
sneakers on.
my question's about like, is tokenizing RWA like a strategy to capture more on-chain capital towards these instruments? Or is it like vice versa, where we're bringing traditional capital, like really an onboarding mechanism to come on and then try out all this capital and this innovation that's on-chain, irrespective of where it is? Like, how are these capital flows? How do you guys think about these flows?
I mean, I think it's a non-correlated asset class to the crypto native capital markets, which creates a long-term sustainable business model for the protocols that are developing in this space. So you've got these boom bust cycles in this space. Like makes it really difficult to continue momentum if there is ebbs and flows and volatility and adoption and users and demand and capital and all that. So the real benefit to bringing assets to on these rails is to have, diversification in the types of assets that are available in these markets where the technology is amazing. It's superior in so many different ways. But if it's tied specifically, it was like, a 10 beta to the price of Bitcoin, then like this thing is never going to really take off unless you're able to hedge yourself on the downsides where, and that's where a lot of folks were building RWAs in the bear markets because like there wasn't really that much interesting happening in the yield pools on chain because like the demand for leverage wasn't there. But that shouldn't be the case, and that's why, things like bringing, yield-bearing instruments from the real world on is really interesting. I think the other part of it too is going back to the client side. I'm the head of business development, so like all I care about is clients. And like on the client side, you have investors that are sitting on stablecoins, and they're realizing, oh my God, and this is not news to anybody, but the Fed raised rates a bunch over the last like 2 years, and I can all of a sudden get the same liquidity I could get on a stablecoin, but now I can get yield, and I can get paid for it. And so I want the same utility and access to an instrument that feels like cash, but I can get paid for it at the same time too. So that's kind of what I'm saying.
I think, okay, so Jim brings up, I feel like Jim has a perspective that's focused, the clients are primarily institutional for a lot of these products, right? And I think there's another aspect to this, which like the question is focusing on to what extent do people that are transacting on chain have demand for these things? And I think the awareness of the users on chain being, degenerates that want to use DoggyFi, for example.
Hi guys.
And like have a higher risk tolerance also opens up access to markets where ultimately like RWAs can be used as a tool to expand use cases for people outside of blockchain. And these people that are degenerates on chain can provide the capital and they're totally willing to do it. So that's like the example that I gave earlier on like SME lenders and the fintech originators. It's a great example of people that have a higher demand to extend credit to a random startup in Africa may be willing to because it's 20%. There's also an essence here like of people don't know what they don't know in the real world. In the real world market. So like a good example of this is like AgroToken, which is based out of Brazil and Argentina. And they're primarily providing tools for Argentinian farmers to tokenize and use their grains that are sitting in their silos to collateralize financial products, which they previously were already doing this because they don't trust the actual the currency, the local currency, for obvious reasons. But there's like different sort of there's a decoupling between the access to liquidity that these guys have that they don't understand. There's other options here where, instead of selling 30K pounds of grains, you can bring it down to 10K and access more liquidity in that way. And so like there's an essence of people don't know what they don't know until they see how this applied software can expand a lot of their real world asset businesses.
Yeah, I think another question, is who's going to fund these projects, right? Like, someone ultimately has to make it their business to go and tokenize something that requires mostly investors, right? And that really hinges on the investor climate and what are investors looking for? They're mostly looking for shorter term opportunities to dump a token in 2 years, right? So that probably drives new projects towards on-chain users. Ideally, that do have use cases off-chain, but I think successful ones will probably be looking at what on-chain users really need, like treasuries, like other things like that, and create a token on top of that fits along with the project, and investors will probably fund those things. It's harder to get these more esoteric cases funded, right? Because you talk to these people, and we get inquiries on this stuff. It's like, who's going to fund this thing, and how long? What's the payout going to look like to get the benefit of tokenization when you're tokenizing wheat or some grain silo or whatever, right? The timeline's too long. So I think right now, right, is where we're still looking for a couple RWAs to come on chain and be successful. I think treasuries has a good shot, right? And when that happens, we need 1 or 2 more before we see the cycle go even beyond that.
And it's interesting because as a US participant, I am advantaged in the fact that I have access to all of these great asset classes and good trusted financial systems, but it's especially important in terms of emerging markets. I think in terms of a US participant, a lot of these alternative asset classes that are not correlated, whether it's, fine wine, watches, art. I saw an interesting project the other day where it was like tokenized raced horses in terms of like breeding profits as well as race profits. And so I think that's very interesting to me as a US participant. Like, I know nothing about racehorses, and I can go into this platform and make kind of a portfolio that fits my own risk level and let someone else manage this portfolio of racehorses or fine wine. So getting democratized access to various alternative asset classes makes a ton of sense for blockchains, and especially in the form of tokenization. I do think kind of private credit is in an interesting place because where we're at in terms of the credit cycle, spreads are the tightest they've ever been, yet on like risk-free T-bills, et cetera, you're getting 5%. So it almost doesn't make a lot of sense in terms of going too far out the risk curve until spreads start to blow out in terms of widening, and then obviously those yields will go up in terms of private credit markets. And then I think there'll be more demand for private credit, SME financing, et cetera. But at the current rates, it's kind of interesting where it's just so tight, where it's, I think people know that it's either, hey, the economy has a downturn, spreads widen, et cetera, and it gets a little bit more attractive in terms of the risk you're taking, versus right now it's like, all right, this loan could default and it's getting 10 to 20% yield versus I can get 5% yield on T-bills and have basically riskless yield unless you are betting against the US government. But
yeah, I do want to put a different perspective here. Basically, you asked the intent, what's the intent of RWAs? Is it to get TradFi in, or is it to build something new? I would say it's none. It's rather to dollarize the whole economy again, right? Like he was saying that basically there are people who don't have access to US bonds and treasuries. That's a way to get access to US bonds and treasuries. But if you see on the hindsight, that actually lowers down that particular economy's hold on its own currency. If people don't trust Lira and its government and start buying USDT, that's dollarization. And you guys have already done that with, we don't have to talk about that, but the gold dollar markets and stuff like that. So I would say it's still a bit concerning for emerging markets and emerging economy when RWAs start getting created and there are ways that people can just directly buy in T-bills without being accredited investors, right? So in a way, if I am living in Argentina or if I'm living in Turkey, even if I'm living in India, I would not want to hold INR and have 12% deflation on my currency. I would rather just go ahead, buy USDT, USDC, and get a 5% yield. At the end, it's me getting benefited, my economy getting a lot of losses, but at the best, US making a lot of more money with more capital for itself. And in the G20 FIU thing, where like crypto was a particular topic for the first time, all the growing economies had a problem with this particular nature of stabilization and RWAs being created. So for sure, it's a concern. But on the other side, if you don't look at that particular part, there is always this, the reason why we created crypto is to move away from banking and move more towards self-sovereignty. This way we are getting back to dollarization, APYs, just, and that's what happens in bull markets. You're like, just, it's fine. We don't want to be cypherpunks. We don't want to let's just have some APYs, like 100% per day, and do the Doge things, right? so it's in my opinion, it's concerning, but again, it has some goods and bads. So I do want to put the other side of the perspective as well, because I do belong to a up-and-coming economy, which might have threat to stables and the RWAs that are created by that stables.
Yeah, I love this. It feels like there's various tones of like directional and intersectional thinking that's happening here, right, between these assets and how they can be affecting users. Yeah, thank you. I'm definitely not taking off my tinfoil hat now after what you said. I guess my next question is like, how do you envision like derivatives integrating into RWAs? Like, what are the implications for liquidity, strategies? Like, what are your thoughts? Tell me the alpha and like how to structure my portfolio.
Well, I think derivatives, what they do is they give they allow different types of traders to trade the asset that have different risk profiles, right? So if I'm doing FX or any asset really, and I'm going to do spot, I'm doing it to just make a payment or just make a simple trade for a commercial reason. But if I'm using derivatives, I'm probably speculating or I'm hedging, I'm doing something like that, right? So for healthy liquidity, you need different types of interactions with trading, right? So if I'm just doing spot trading all day, that's one type of person. If I can let people lever up and go crazy with speculation, now I get all these people trading and giving me pricing like day traders real time, right? So I get liquidity on this asset that I created all day long, all night long, and derivatives are basically a necessity, right, for you to have liquidity for any asset. So that I think it's a must, right? If you're going to bring an asset on chain, derivatives have to be a part of it for it to really take off.
Yeah, I think hedging as well as like in the case of cables and shift markets, like interest rate swaps makes a ton of sense, especially as currencies appreciate and depreciate against one another, and the kind of current monetary environment we're in. I've even seen some interesting protocols doing credit default swaps for centralized exchanges, meaning you could have hedged your FTX risk if they existed a year ago. I think the biggest challenge right now in terms of on-chain derivatives in general, especially options, is just liquidity. You look in TradFi and various assets, you can buy options on basically any ETF these days, and you're seeing like 0-day expiration call and put options going crazy, especially in like the AI names like NVIDIA, et cetera. And so I think building that liquidity on chain, and like you mentioned, it allows for kind of a different barometer of risk, meaning you might have someone more risk averse that's constantly hedging on chain, or someone that's more of a degen and levering up. But so yeah, it just really depends.
Are you even living if you're not at 200x leverage? You know. Thank you. Does anyone else want to chime in on that, or?
I mean, I would just say very briefly, what it enables is, more structured products. I think we talk a lot about the yield-bearing RWAs, but there's a ton of other things that you can put into a token that represent equities or other asset classes. And so what I think it allows people to do is be, they're very composable, and it allows, one of the biggest departments at a big bank, and I'm going to go back to being the suit guy here, is the structured products, right? And so like there's these baskets and hedges that are bespokely created for clients that are looking to, whether they're hedge funds or they're long-only asset managers or they're corporates, like there's an entire industry of structured products that enable people to get the type of leverage or hedging that they're looking for based off of what they own. And so that surface area on top of this industry will enable that type of interesting use cases as well.
Cool. I was in a Twitter space recently, a couple of days ago. I met this guy called Cephii, who's like a Cosmos evangelist in Link Marine, right? He believes CCIP is the base layer infrastructure to unite all the things RWA. I know it's like me coming up here and, that's what he's saying. I'm just curious to see, like, how does infrastructure and verification really work? Like, there's so many things that has to be built across the stack here. How do these assets get on there? How do individuals access them? What's your thoughts on this?
Oh, okay. I'm the infrastructure guy here, and maybe the only engineer in the panel. The only engineer, all right? All right, so basically, like we were talking about a lot of, way we can use tokens to get on chain and start doing things. What's funny is that we currently might not have the right kind of infrastructure, which is as decentralized as we want the RWAs to be. How do you put a real-world asset on chain is basically using oracles. Which oracle do you use? You use Chainlink, Redstone, 2 or 3 of these. They don't operate as much in RWA space itself. And for these particular oracles to have been a part of a particular chain, there are certain sets of requirement to make things happen, right? So it's great that we are already talking about these parts, but we first need to build the tech. We first need to build the infrastructure to get the Trump Tower on chain and then short it for $0, right? It's very important. So that's one part. So putting stuff on chain is really tough. And then when it comes to putting that data off chain, that's again as tough, even if not more, right? Like I talked about, we are an APY industry. All we talk about is how much yield you can bear, how can you go 200x on your particular trade, right? How can Uniswap go from a governance token of cutting hair to more yield-bearing kind of a situation? But for all this to work, you need to get that blockchain data to your particular front end, and that's where the graph comes in, right? I need to say that. I had to say that. That's where the graph comes in, but still, we don't have the infrastructure ready for putting stuff on chain and still to get that data off chain, because there's still a lot of work on both the ends to make one of these work in a decentralized, trustless, secure manner where infrastructure worth $1 billion or more can be traded.
So I kind of disagree. I think that it's pretty straightforward to bring stuff on chain, and it's much more about the management of this asset. And ultimately, it's not dependent on the Oracle necessarily, as an Oracle is a function of liquidity. And it's much more a question of how to manage the liquidity resources that's backing this asset. And then also who is using it. And like CCIP is great because it kind of it enables at a lower level for the asset originators to access the infrastructure. And like ultimately, the bottleneck is not so much, so the bottleneck is the real world entity that's custodying this thing. And then being able to provably issue this on chain and connect the issuance of this on chain to what they're custodying off chain. And it's not so much, so I think that this streaming of this data from Web 2 to Web 3 is where that gets really interesting. But ultimately, that data is the liquidity and the assets, the details of the asset, et cetera, all kind of bake into that.
Just one particular thing, Oracle manipulation is a really big issue. Even Uniswap built its own Oracle because of that particular thing. And there are DEXs who don't want to rely on Oracles, and people have put in billions of dollars to build non-Oracle based DEXs, so there is no security threat. So that still remains an issue, and just imagine if you have $1 billion put on chain, the Oracle needs to be trusted in a decentralized fashion. If you are decentralizing on the name and those Oracle are basically getting information from each other and making things happen, then it's a tough game. But I mean, I'm optimistic. I'm sure we got the tech, we got to build it.
It's just like oxymoronic though to custody something off chain but decentralize it. Right? There's like, the RWAs are not decentralized. You could build a protocol that allows decentralized access to it, or a decentralized liquidity engine, but ultimately there's a level that you cannot get around that too.
We can agree to disagree.
Yeah.
And that's what I wanted to add. I don't want to like step on any toes, because I feel like the ethos of crypto is like democratization, getting away from the suits, etc. But unfortunately, like when you split the institutions into crypto-native institutions and then your bulge bracket banks, they're very different in terms of what they can use. So the crypto-native institutions a lot of the time can use permissionless blockchains, but they might use permission pools and various protocols, etc. The bulge bracket banks that we've spoken with, they essentially want to know what's going on in terms of every part of the stack, whether it's validators, oracles, indexers, exactly. Yeah. And so right now they don't feel comfortable in a permissionless environment. It's all done either semi-permissioned or fully permissioned, in which they know basically every part of the stack, which unfortunately is kind of against the very ethos of crypto itself. But in terms of getting these institutions comfortable, you're going to have to make sacrifices. And so it's really funny when you think about it, because this kind of feeds into the ETF as well. Like the Bitcoin ETFs are making obviously number go up, but essentially now a large portion of the supply is owned by TradFi institutions, whether it's BlackRock, et cetera. And so we're making these I think it's a good maturation process though, because people need to realize that if we want to tokenize the world, if we want billions, trillions of dollars on chain, we need the big banks to be comfortable. And so it's very interesting because it kind of unfortunately steps on the toes of most crypto native individuals.
Yeah, I'm sorry, go ahead.
No, go ahead.
No. Please go ahead.
Okay. So I mean, the question was, how hard or easy is it to get things on chain? And I think we all agree, like the technology is not that hard anymore, right? Like it's the growth is really happening on the connective tissue between the two of those, and whether that's from a legal regulatory perspective or that's from a technology perspective, it's all education and it's all an iterative process. And I think from our perspective, we spend a lot of time dealing with traditional banks, traditional asset managers, traditional auditors, to get them comfortable with the distribution strategy that we have. And so, I think it's very synonymous to the ETFs where, folks were really like underwriting the asset class, but then they didn't have to underwrite the structure. It's actually and I say synonymous, I mean the antithesis. That's what we're trying to do in tokenization. Is like we're trying to take a very traditional structure and put it into a very new distribution platform. And there's a lot of great initiatives that are happening. Avalanche subnets, for example, there's a lot of adoption that's happening there. A lot of great POCs with like Project Guardian. Onyx is doing stuff every single day. And I think we're all excited about that, but it's not going to happen overnight where everybody's just going to be completely decentralized and doing it on Ethereum. The regulators, especially domestically, are not ready for that anytime soon. And so what we're seeing is, a lot of negative headlines and headwinds. But from what we're seeing underneath the hood is that the staff level is actually really supportive of the innovation. And it's maybe a very contrarian statement that I just made there, but like I'm actually kind of bullish on the future potential for tokenized assets to have a time in the sun here in the States. Because I think there's a lot of teams that are out there that are willing to engage and bring the industry forward from the not so sexy stuff, which is off chain, and doing stuff with like Ernst & Young and with a custodian and with a fund admin, and letting the technology itself continue to mature at the same time.
Yeah, I mean, unfortunately we've run out of time. It would have been fun to think about what's the wildest RWA asset that comes on there, but that's something that you guys will have to talk to these guys about.
Trump Tower, like shorting Trump Tower to go to zeros. There you go.
That's the trade to get in on, guys. But yeah, I just wanted to say thank you guys for coming up here and chopping it up. It was fun to hang out with you guys, and feel free to talk to them after. Thanks, y'all.
Thank you.
Thanks.
Yeah.